Wow. It's always amazing to me that this works. And so, everybody, I want to welcome you to our last session of the day of our third day of Boston FinTech Week. I'm Sarah Biller, the co-founder of the FinTech Sandbox, executive director of Vantage Ventures. And I have to say, I'm enormously thrilled to be with these three guys today as we get into the last session around DeFi or decentralized finance and the power of the blockchain. And I'd be remiss if I didn't tell you how thankful we were to Algorand to help us think about the content you've heard today. You know, it's been an amazing day. For those of you who've tuned in for most of it, you've heard about how the capital markets are being reshaped, how insurance is being changed, fundamentally altered, what it means to have new payment rails for creators on the blockchain. We had a very active conversation around carbon. And today I feel like I have hit the jackpot because I'm talking today to three individuals, a serial fintech entrepreneur, and investors, operators, technical guys, all of which here are envisioning what the future looks like with the blockchain and DeFi. And so I just want to welcome on the stage and ask the gentlemen to self-introduce themselves. I'm going to kick it off with you, Mike, just an appreciation again for the three of you hopping on to this call. We want to make it dynamic and energetic, but let me just tee it up right now, Mike, and ask you to kind of give us a brief background of yourself. You're so well known in the industry and want to really get a sense of what brought you to Figure too in your introduction.
Sure. Well, I appreciate you having the time for us today, and looking forward to the conversation we're having. So I'm Mike Cagney. I'm one of the co-founders of Figure. Figure started back in 2018 with the idea of leveraging blockchain technology to disrupt a lot of what doesn't work in financial services. So in particular, disintermediating a lot of intermediation through blockchain technology and focus on areas ranging from lending to payments to exchange. And as part of Figure, we built a blockchain called Provenance. Provenance is now a public open source decentralized chain, but I'll talk a little bit about the evolution of that and the discussion that we have today. Prior to Figure, I was one of the co-founders and CEO at SoFi, and before that, ran a hedge fund, started a wealth management company, and started my career in banking back in the mid 90s at Wells Fargo, where I worked for Tim Sloan. So that's my background in a nutshell.
Mike, so nice to have you. I'm just thrilled. Adam, what about you? What led you here today? Can you share a little bit about your work at JAM?
Yep. Thanks, Sarah, for having us. It's an honor to be here with you. So my background is really as a bank investor for most of my career. The last 5 years at Jacobs Asset Management, focused on U.S. financials. JAM has a 26-year history investing in U.S. financials, primarily community banks. We do it through a hedge fund and private equity funds. But we basically came to the conclusion a couple of years ago that banks were falling behind the curve on tech and really needed to do something about it. Otherwise, the industry could face obsolescence. And so we started a new area called JAM Special Opportunity Ventures, which focuses on tech forward investments. We partnered up with a group called FinTech that is based out of Nashville, stands for Financial Technology Operators, so all former entrepreneurs that built, ran, and sold companies. And we really shared their vision on where the puck was headed in banking and in financial services. And we decided to do a JV where we went out and raised $150 million to where the only investors in the fund were community banks. And those community banks have been very engaged with us in terms of committees, demos, webinars, tech surveys, where we really find their pain points and look for solutions. And right now, I'd say we're focused on areas like back office automation, real-time payments. In so many of these areas, blockchain is a solution. And we started spending time with Mike, introduced some banks to him, some of which have announced strategic partnerships. And we're working with Figure on a new fund and making more introductions for banks and just sort of endless use cases on ways these banks can work with Figure and build on chain.
Yeah, Adam, I think it's just so forward thinking to begin, Mike, with your work in the blockchain, bring back the technology to these community banks and strengthen them. And Ryan, I know you have a big role there too at JAM, thinking about more of this, kind of pushing into the operating activities, helping the banks see a way forward. Can you introduce yourself to the group?
Sure. Yeah. And just to echo Mike and Adam's sentiments, really appreciate you hosting us today. I've been at JAM for 15 years. I'm the director of research at JAM, general partner at JAM Special Opportunity Ventures. I just coordinate the research efforts across all our vehicles, public and private. As Adam said, all our investing is across the financial services ecosystem exclusively. So we feel like we have pretty deep insight into traditional financial services. And then before that, I was an investment banker in Citi's financial institutions group.
Ryan, thank you, because your perspective and your forward-leaning look through the lens of research, I think is going to be critical to this conversation. Because,
Sure.
When I went out and I started thinking about Figure and its goal to really transform financial services through the blockchain, I couldn't help but think I was a little bit on a safari, to be honest, and that I was getting ready to see the big five of FinTech through your eyes, Mike. Let's just face it, you've built an industrial strength capability for individuals and institutions that do things we care about in the FinTech community: payments, lending, investing. You've got some private fund services on there. And I really was hoping maybe you could kick us off a little bit and just share more about Figure and the seismic change we're going through in financial services that led you to build out the capability.
Yeah, so I think the underpinning of this is, what is blockchain good for in the financial services applications? And blockchain does two things that matter a lot. The first is the ability to displace trust with truth. And so the ability to look at an asset on the chain and know definitively that asset is what's being represented to you. It is owned by the owner. It isn't encumbered. There's huge amounts of application for that. And when you couple that with the ability to transact bilaterally, so using digital marker or some digital representation of fiat between buyers and sellers so that the two can face off directly and transact real time without counterparty risk or settlement risk, you create a structure that has tremendous applications into the $13 trillion mortgage market, into the disruption of the $1.2 trillion interchange monopoly, into the disruption of $1 trillion plus in five-party exchange systems. And so, we were extremely excited about this coming into it. The challenge that we had in 2018 was everyone was talking about blockchain. I can't tell you how many banks had blockchain innovation groups that were doing proof of concepts on blockchain, but no one was doing anything real. And no one wanted to be a first mover. And so we said, well, you know what, we'll create the operating businesses and we'll be a first mover. So we created Figure Lending to originate loans, custody, securitize, and ultimately sell those on blockchain. Figure Payments to do real-time payment rail transactions outside of interchange, ACH, and wire. Figure Exchange to run real-time security transactions. And we'll go into these in some depth as part of this transaction. But we've done billions of dollars of transactions on blockchain at this point with over 50 banks, community banks, regional banks, and national banks, and fund counterparties. And that's growing every day. And one of the big milestones that happened a couple of weeks ago is New York Community Bank issued a digital fiat marker on chain bilaterally to support a secondary transaction that we were doing of private equity, private company stock, where, sort of paradoxically, that stock traded at T instant versus T+2 on the NASDAQ. But more importantly, I think this is opening a bridge for what was called USDF, or US dollar forward, but a structure where I think we have a path where banks are going to build a reciprocal network to lean in and provide significant amounts of fiat on chain. And that's been one of the biggest limitations that we've had within the blockchain ecosystem is lack of fiat. I'm sure a lot of the folks on this call understand, with USDC and USDT and limited supply relative to demand, the repo rates on those tokens are very, very high. I think that will go away as the banks are now leaning in and saying, look, we can actually do an FDIC-backed digital marker that works for real-time settlement on chain. And that's really what's going to unlock a huge amount of value, because before we were before we had the banks doing this, Figure basically played the same role as Circle and Tether. You'd wire the money to Figure and we'd fund your digital wallet. But in doing so, you were taking Figure risk. And so taking this into the bank system, I think is going to introduce a huge amount of fiat liquidity on chain that's going to support the kind of use cases that we're trying to execute to.
Yeah, Mike, I can't stress enough. Earlier conversations really talked about the capability, the need for the capability that you're pushing forward with Figure. And one of the questions that kept coming in over and over was, well, what are some of the key learnings either you had through this process, through this monumental moment of a real-time settlement, and or if you want to go here, some of the learnings that your bank customers, your bank partners had to learn? Because I think that's another thing that we've heard through the day is that there's still a long way to go to educate our banking system, our financial services system.
So I'll talk to both those, and they're both great questions. I think in the context of Figure, the first thing that we did on chain was loan origination, custody, servicing, and subsequently aggregation into a warehouse facility and a securitization. And what was interesting for us is we came in with a thesis that we'd save about 85 basis points of transactional costs from eliminating audit and QC expenses, eliminating the process of delivering collateral into the warehouse provider, eliminating the traditional structure around securitization like the custodial bank and payee agent and so forth, where blockchain technology could supplant the need for a lot of those things. And we actually demonstrated 117 basis points of transactional savings on the first deal that we did. And we wrote a paper about this. That paper's available. I think it's on provenance.io right now, or it might be on figure.com. If you can't find it, just send either an email. But we went through and did a bottom-up audit across, this is what we used to pay, this is what we pay now. And what was interesting to it is there were some things that ended up working better than we expected. There were some things that didn't work as we anticipated. But one of the key things that happened is the blockchain supports a real-time remit platform, meaning that I can go on at 12:57 today and see every loan that's paid me as of 12:57. And as loans pay, they accrue into the chain real time against those transactions. That proved to be extremely valuable in March of 2020 when COVID shut down the economy. No one knew what was happening with mortgages, and our collateral stayed completely liquid because you had real-time visibility to performance. And so, we always felt there was a significant liquidity benefit, but we thought the liquidity benefit was coming from T-instant settlement, not from the visibility and transparency of the collateral. But we ended up getting that benefit from the liquidity and transparency of the collateral. So that was an important learning on our side. I think on the flip side, what the banks are beginning to understand with USDF is they have a medium to facilitate real-time 24/7 payment. And what you're going to see, I think, are banks leaning in to provide USDF into use cases like secondary transactions or any either asset or security transaction that's happening on chain, and being able to facilitate that to drive to riskless settlement. But the banks are also now looking at this and saying, hey, this is actually a better rail for payment. And because it's programmable, there's a whole set of second level use cases that come off of this. So for example, we're talking about standing up an accounts payable receivable marketplace where the invoice is a digital invoice on chain, digitally signed by both parties. And what's unique about this is rather than someone going in and bilaterally negotiating the factoring of that invoice between payer and payee, because you have certainty to this, you can step in as a marketplace participant, whether you're an investor or a lender, and buy or invest into that contract, where you're now putting an amendment into that smart contract such that when the invoice gets paid in USDF, it goes to you directly, the owner of the contract, not to the underlying payee, where you take the idiosyncratic risk. And so what I think you're going to see on the back of USDF is a whole set of both second and tertiary use cases that come off of this, where the banks are realizing this is incredibly powerful for them. And what's interesting with the JAM team is we're doing this with regionals. And what we're doing is we're actually allowing the regionals to leap over where JPM is with JPM coin and where Wells is with what they're trying to do in the digital asset space. And really, not just leveling the playing field, but putting them ahead of where the money centers are in terms of leveraging the tech. And that's, our role in that and our motivation in that is we're giving technology out. again, at the end of the day, we have our operating businesses. They matter a lot to us, but ultimately we're about ubiquity of blockchain adoption. We want everyone on provenance. We have a economic interest for that. We own a lot of the utility token on provenance, which is called hash. And so, there's certainly economic incentive for us there. But what that means is we give away tech. And what we're doing is providing a streamlined path for banks and other entities to leverage the technology. The Provenance Foundation is now doing hash grants for third-party development on provenance. And at the end of the day, what we're aiming for is ubiquity of that blockchain.
Yeah, Mike, I love it. I'm going to go to Adam and Ryan for a minute to talk about the thesis around the fund, but I just want to pick up on something you said that I think is so critically important for who we know is listening in. And you talked about sort of transparency in the liquidity, in the risk, right? So the transparency that you have and the liquidity, which is something that almost killed all of us in the last credit crisis. For those of us who are as old as I am, I think Ryan and Adam, you all were like twinkles in somebody's eyes. But in that reality, I do wonder, when you think about your bank customer, our critically important community banks, can you just kind of balance what is the opportunity set here? Is it closer and clarity on the risk, or is it the cost efficiency that you mentioned too? Because I heard both. And I don't know if, Mike, you have an answer as to what really, for Figure, what's the outcome, or maybe it's both?
Yeah. I mean, I think in the context of Figure, again, there's the first order benefit of leveraging blockchain. And I remember, when we started Figure, one of the venture investors that participated in the first round said, "This is great. You're going to have a huge comparative advantage on this technology." And I said, well, you have to realize that the ultimate goal is that I should lose that comparative advantage as the rest of the industry is crowded in to adopt it. And so I'm going to get first order rent, or first mover rent in terms of being an early adopter, and I'm going to get the economic benefit of that. But ultimately, what we're really doing is accruing to the ecosystem, and that's where our holding of the utility token comes into play. But I just think you're looking at such transformational use cases. I mean, think about USDF as an alternative to interchange, and think about $1.2 trillion of market cap between Visa, MasterCard, and PayPal. And so what you're talking about is probably one of the most substantive disruptions of market cap that we've ever seen, because you're looking at trillions and trillions of dollars that's baked into the whole function of intermediation of, 5-party interchange system, 5-party exchange system, $13 trillion mortgage system, and all the custodial and infrastructure process you have there, which we live and breathe every day. And this is why you're looking at something like Ethereum, and it has a $450 billion market cap, because that's justified if they're successful in displacing traditional financial verticals. And that's the same way we look at provenance. And we think what's unique about provenance is it's super fast, it's super cheap, and you control your own data, which, we can get into the nuances of that, but that's one of the biggest limitations of level 1 chains right now, in terms of how you manage and control data, especially as a loan originator, for example. And so if you go across the ecosystem, you won't see a lot of mortgages on blockchain other than on provenance, because it's built in a way to support that type of infrastructure. But I just think we're at the cusp of one of the biggest reallocations of market cap that we're going to see, probably in our lifetime.
Yeah, I think that's right. I think we're seeing a reordering that's happening, even and faster. Not only
very fast, and it's going to come so much faster than people anticipate. And I think a lot of people have their head in the sand. They're pretending it doesn't exist, and we're hearing, oh, you can't do this, you can't do that. I've heard from DTC that you can't do real-time netting on a blockchain. Well, we just demonstrated you could, and in fact, you get all the same leverage and benefits off of that, and you can trade T-instant, so you would never have a GameStop fiasco. Again, our view is, look, we don't need you to trust us. We'll prove it, and as we prove it, and as we build the broader ecosystem and crowd in these banks behind us, it's going to hit a tipping point pretty quickly.
Yeah, agreed. And Adam, Ryan, I'm going to get you in one sec, I promise. And Mike, I'm sorry to do this to you. We're
that's fine.
Pummeled over here with some audience questions that are germane to what you're discussing. And so give me one sec, guys, because I'm going to come to you. But Mike, let's get this question on your mind. Can you address throughput? There's providing real-time payments requires the ability, obviously, to support extremely large volumes of transactions simultaneously. How's that fit?
So Provenance is a level 1 sovereign chain built around Cosmos Tendermint, and we can run easily 10,000 transactions a second through it right now. And in fact, we demonstrated that for DTC, a circumstance where a trader went in and transacted 10,000 times a second, and showing real-time netting and stablecoin in that context. And what's interesting about that, if you kind of extend that whole use case that we did, and this will give you some visibility to the level of disruption that you have. So in a first order, you say, okay, and by the way, the highest throughput Visa runs at holiday season is 10,000 transactions a second. So 10,000 a second is a very good milestone to benchmark into in terms of your ability to scale. But what you get, and sort of to give you some illustration of the level of disruption, on the first order, you can say, okay, we can set up alternative exchanges of digital assets on blockchain. They can trade and settle real time. We can process 10,000 transactions a second. But remember, this is a decentralized exchange, meaning that the way you transact into that is you attach your wallet to the exchange, and your wallet will have a KYC passport or a stablecoin position or what have you. But there is no concept of introducing broker. And remember that if you want to lend into those assets, you have perfect encumbrance of the digital asset. My dog's going to bark, but we'll let him go off and do that.
You keep talking. We're okay.
He saw a squirrel, and he really doesn't like squirrels. And so you have perfect ability to encumber into the asset to lend against it. And so not only are you disrupting the exchanges, you're disrupting the entire brokerage industry, because you don't need a broker anymore. What do you need an introducing broker for? Because you can get leverage by perfecting security collateral in the marketplace on a decentralized basis, and you attach your wallet. And you know what? You own the security. And so you decide if you want to lend it out or you want to repo it or whatever you want to do in that context. And so you're talking about, again, not just first order exchange disruption, but the entire brokerage system disruption off of this.
Yeah, Mike, it's amazing. And it gives me just a minute to give you your breath back and ask Adam and Ryan to weigh in, because everyone's mind is whirling right now. And Adam, the question is, you launched a fund at a very important moment to invest in entrepreneurs like Mike, in partnership with Mike. And I think I was going to talk to you about sort of like what led you here, but I think we all know now. But really, if you wouldn't mind, why don't you talk to us a little bit about the tangibility, sort of where you find your investment themes, share a little bit more about the fund structure that brought you and Mike together.
Yeah. So there's a couple points here that, we represent community banks across the country. I think NYCB, one of the first banks that was introduced to Mike, is sort of a perfect example of a institution that really had no tech innovation, but a new CEO came in, was looking for something to do with blockchain, and they hit it off with Figure. And there was a lot of pushback initially of like, we can't do this, but they, after many meetings, they realized not only can we do this, but this is a better solution. And they really broke through those barriers that had been up forever. And I think that it's just proof that, minting being the first bank to mint a USDF digital marker was quite an accomplishment for this institution that no one saw as a tech leader. And so for the younger management teams, the teams that are willing to lean in, Figure has 132 engineers, and they're willing to work with you. And that's sort of that. I don't think that offer is going to be around forever, but for the early movers and adopters, for us, that was a critical reason why we said we need to do this fund with Figure. Figure will be a strategic investor. Mike will be the lead of our blockchain committee. And so it's a way for the community banks to remain relevant, to have a seat at the table, because all this innovation is going to happen. We're confident of it. The other point I was going to make was 2 days ago, we spoke with, we'll call it one of the top banks in the country, really in the world. Their leading blockchain expert has basically been in a closet for the last 5 or 10 years, and nobody spoke to him because every blockchain project failed internally at the banks. Wow. And he basically has told us that he's the most popular person at the bank right now, that there's been a messaging change from the board level down and management. And, we've hit that tipping point. And I think that that's just where we are as an industry, as a society. And, it's going to move even faster here. And so as someone who represents community banks, we just felt like we had to do this so that they can remain relevant for their communities.
Yeah, Adam, thank you for that. And Ryan, I'm going to come to you in a second to think about the research that's kind of leading this thread, pulling the thread through. But we have had this really important question from the audience too, Adam, that fits with what you're saying. But it's Mike, it's this idea of like, what Adam just said. You've got community bankers that are, they're decades in the closet. They're not really coming out. They're learning as they go. The boards aren't totally bought in. And this question came in, what does the experience of talking, a figure, the HELOC, your human equity line of credit, look like for Joe or Jane Public, who probably doesn't know much about DLT and tech savvy? What does it look like for them in practice?
Yeah, so the key is that you shouldn't need to know that you're on a blockchain. And if you think about what we did on the HELOC side, we did a lot of technical innovation around that wasn't blockchain specific. So we can underwrite a HELOC in 5 minutes. It takes a bank between 45 and 90 days to do it. And that's not blockchain. That's just technology and AI and other aspects that we're leaning in on. And so as a consumer, it shouldn't be disruptive to you at all. And what ultimately is going to happen to the consumer benefit is, we can originate assets cheaper than anybody else in the market. And as more people come in and start to originate assets as well, the same way, we're going to revert back to the margins that we've always had to the benefit of the consumer. And so ultimately, this technology transformation is going to manifest through better prices to consumers, in terms of lower loan rates or lower cost to move money or what have you. And this is sort of, all good tech is deflationary in this context. And this is another clear example of it. But I think, as it relates to the banks, Adam raised a great point. NYCB was an interesting example of a bank that is not known as a technology bank, has not made big investments on technology, and then being the first to actually bilaterally mint digital marker on a blockchain, and it is a huge deal. And I think they look at it and say, look, we see where this is going, and we want to get in front of it in a significant way. Medium-sized banks shouldn't feel relegated that they have to follow JP Morgan in terms of blockchain innovation. That, the reality is, again, we can get them ahead of where all the industry is right now, and in a way that's constructive the whole ecosystem.
Yeah. When you talk about the sort of 5 minutes, is it just walk through some of us who haven't seen HELOC? Is it an application? So help us get that real.
You go to figure.com and you apply for a HELOC, and the biggest technical hurdle is, sometimes their browser doesn't work, or you have to take a picture of yourself for identity verification, and sometimes that process is somewhat challenged. But it's just a simple online process. You do it on a desktop, laptop, or mobile. And mobile, obviously, it's built specifically for the mobile device, so things like pictures tie into your camera and such. But it's designed to be a streamlined process, and literally you can get approved in as quick as 5 minutes, and in fact, a lot of people do. And if you compare that to 45 to 90 days in the industry for that same loan, you can see what the benefit is. And that's, I think one of the important things is our human capital cost to originate that asset because of technology is less than 30 basis points, whereas it's, well over 100 basis points in the broad industry, and actually running north of 200 basis points. So, but I want to emphasize that this is just tech, and in a lot of circumstances, the banks, haven't made or haven't invested as much on this kind of technology as I think they should have. This is something that through JAM, we private label out and are letting banks starting to leverage this technology and integrate it into their offerings. But then this is all fully integrated into Provenance blockchain. So when you create that asset, it's a digital asset on chain, and you get all the benefits downstream of that. And that's where you really start to extract a huge amount of value, especially as it relates to aggregating or repackaging or selling those assets in marketplace, and being able to do that on chain versus off.
Yeah, Mike, thank you. Because we're going to talk about this a little later. We'll probably use it as our closing remark, but I can't help but tell you, we've been noodling for about 1.5 years, and COVID accelerated our questioning here at the FinTech Sandbox about how you build a financial services system that works for everybody. It's the first question. Yeah. What do we need to do?
Well, I think it'd be, and I won't dive into it because I'll let you close on it, but this is one of the great things I think blockchain does, which is I think it'll level the playing field, especially to traditionally disenfranchised communities, where it's been difficult to deliver sustainable financial solutions into those communities. I think blockchain will allow that to happen and basically level the playing field in a way that FinTech hasn't done yet.
Yeah, I mean, like that's what I hear you saying, and it's anybody, it's anywhere, right? You just, by and large, and then this notion of any time, and there couldn't be a more critical moment than what the crisis revealed to us, that we need solutions like this. We don't need a 45-day wait to get your loan. You need to figure out now, and so I think it's a really important moment. We'll underscore it again, but I want to ask Ryan to weigh in here a little bit about his own work and research, and that sort of you're hearing Mike lay out the actual ability to do what we envisioned when we started talking about, how to wrap up content. Ryan, what are you doing on the research side? What's your thoughts on where things are heading, given the foundation Mike is building?
Look, I think we're coming at this from not a DeFi purist perspective. So I think we believe, and maybe it's our bias from 25 years of covering community banks and traditional financial services companies, but we believe that there is a role for them to play in kind of the DeFi ecosystem. What they need is infrastructure and on-ramps in order to facilitate that. And their role may very well change from what it is today. It might be leveraging their relationships, their contacts with customers, their ability to underwrite credit, and it may be less about their balance sheet capacity. That capital might come from the DeFi community. So I think that's kind of like the starting point that we're coming from, is that we think that there's an opportunity for traditional financial services to lean in and use blockchain for a lot of different things as kind of the underlying infrastructure, to the point where in 5 or 10 years, we're not going to be talking about blockchain. We're just going to be talking about business as usual, and blockchain or distributed ledger is going to be, kind of how they operate. And kind of part and parcel with that, we think that there's kind of some competencies that they can start developing dexterity with today, things like digital asset custody, understanding how to hold keys, or developing the infrastructure to hold, digital keys, being able to read and write to the blockchain to encumber assets or confirm that assets aren't encumbered. Because our perspective going into this is that over the next 5 to 10 years, the amount of kind of digitally native assets, which right now are kind of relegated to the cryptocurrency realm, but it's going to expand by many, many factors. And it's going to encompass traditionally analog assets like equities and fixed income securities and whole loans. And so if you come at it from that standpoint, then you say, okay, well, if a bank is going to remain relevant and competitive, which is kind of what we're saying we're going to try and do with our venture funds, then these are areas that they need to beef up, and we need to be at the forefront of identifying the companies that are going to help regulated financial institutions do some of this stuff.
Yeah, Ryan, I love that. I think if I had to boil the ocean down and say what is really critically important for the world economy, it's figuring out how to strengthen our banks on Main Street, right? I mean, I think we've seen that, and it's not hyperbole, and it makes me really thrilled that you are thinking about and bringing back the technology that's being built at Figure, the capabilities. And Adam, I wonder if that sort of, are you particularly interested, what trends are you particularly interested in when you look at the investment cycle around the blockchain? Anything you want to share there?
So I'd say that we're focused on a variety of areas. The fund will likely have some proprietary deal flow from the relationship with Figure, but we're focused on building loan marketplaces, building businesses like supply chain finance or ARAP exchanges where there's a lot of chain of custody. It's just those are perfect businesses to move on chain. And there's a lot of interest from banks and investors to do so. So those are the perfect examples of where we'll move those businesses. As Ryan mentioned, digital asset custody. If banks have a role in the future, they have to. It's Safe Deposit Box 2.0. You used to go to the bank to store your valuables in a safe deposit box. The future is a digital vault. So banks need to have that competency. They need to have a strategy, whether doing it directly or as a service. And then they need to be able to lend against those assets, because to me, there's no better lending than lending against something that's in your own custody. and then the infrastructure that is all around that. Data oracles, self-sovereign identity, cybersecurity, in order to facilitate all those on-chain transactions. So that we'll operate in all those different areas, and there's sort of endless deal flow that's already hitting. So lots of innovation happening.
Yeah, it's terribly exciting. And Ryan, picking up on something you talked about too, that Adam lightly touched on, Mike, if I could bring back to you, it's not just payments, it's not just lending, but we see Figure also thinking about taking on the equity markets and some exchange work. So lifting up, can you share a little bit about that? It might be a little early, but I think everyone would love to hear what you're thinking.
No, of course, and I want to answer one of the audience questions really quickly. So it's about staking and yield farming. So Provenance is a public chain. So you go to provenance.io, you can set up a validator on that network, and then effectively barter for delegation of hash. So just to knock that one off, that yes, awesome. You can do that. So I think as it relates to exchange, obviously we did a relatively high profile partnership with Apollo, where this is Apollo's first leaning in heavily to blockchain. And effectively we're working with them across all three verticals. So we're working with them, significantly around mortgage origination and what we can do with mortgages on chain through Athene, which is their captive insurance sub. We're working with them on pay, where we're looking at different entities of Apollo that can stand up challenger bank solutions, where they're using a common backend blockchain ledger and all the efficiencies that come off of that. And then we're working on the exchange side, and in particular, what they're initially focused on is, can they set up a feeder fund on chain into their flagship alt fund, where you do both a primary capital raise and then subsequent secondary liquidity on chain, where you can trade that as a T-instant asset. And we do this today with a lot of companies. I think we've got about 150 that now run their cap table exclusively on blockchain. So they're not using the traditional certification process that sit in the lawyer's office. They actually have digital equity that exists on chain, Series A, B, D, C, D, et cetera. But the benefit of all that is it massively facilitates the rollout or the ability to do a primary issuance, but it allows those companies then to turn on a secondary marketplace. And what we demonstrated a couple of weeks ago is we set up a structure where Figure had 72 employees sell stock to two institutional investors in a limit order book marketplace to de-risk and demonstrate this. We waived our ROFR on it, obviously, to facilitate the transaction. But what we're doing in about a week is just turning on a straight up 24/7, 365 limit order book to allow our stock to trade liquid. And we have the ability to turn that off at some point if we wish. I don't know that we have any incentive or motivation to do that. But with the advent of the ability to have digital marker, digital fiat on chain, with what NYCB and other banks are now doing in terms of supporting that, again, I think you're going to see the marketplace use cases explode. I know earlier you had a carbon market discussion around this. Blockchain is a really interesting carbon market solution on a marketplace basis, because you to one hand, it's not, because you have to trust that the carbon offset was created. And that's a little bit orthogonal to the way that blockchain works. But if you take that as given, then the ability to trade that carbon credit and then retire it on a public chain. So I'm United Airlines, I buy it and then I retire it and everyone sees it, right? There's no, you don't have to take my word for it or at a station. Like, you can go on a public ledger and see what everyone's done. You're going to get a lot of these exchange or marketplace applications, and ultimately, these are an existential threat to not just NASDAQ and ICE and the US exchanges, to the international exchanges, and then the off market, the bond exchanges and the loan market exchanges as well. We have a moniker that we use internally called RTEM, which is Real Time Everything Marketplace, that we think everything will end up trading on a single blockchain, where everything is a digital security or a digital asset, if not a security, and that marketplace will facilitate real-time counterparty riskless transactions.
Yeah, Mike, it just blows my mind, just having been for the last decade in this side of the business, and it's fabulous. We do have a question that came in, which just went off my screen. Jim Smith.
It's about why roll out pay on a state by state basis? So
yeah.
so You're hitting one of my challenging sore points. So Figure has an OCC bank charter application in play, and the reason we have that is we have about 200 state licenses to do all the things that we do. And so obviously, we average about 4 licenses per state. You can do the math, but in some circumstances it's 6 or 7 licenses, and some it's 2 or 3. And to operate Pay, we need a money transmitter license. And so we're in the process of getting all 50 MTL licenses, and we expect that to happen. But it's a good segue to what Pay is, which is we built a common ledger on a public chain that any bank can attach to in lieu of using Fiserv or FIS or Jack Henry. And it has the benefit of being public, open source, and free. But it has the benefit that if any customers on that platform transact, it can go through a blockchain rail, not interchange or wire or ACH. So it facilitates the movement of value real time between counterparties within that ledger. One way that we're driving adoption of that ledger is we created a solution called Pay, which is a mobile banking solution, challenger bank solution. It has a couple of interesting features to it. So it has all the normal bells and whistles of a challenger bank, like early pay. So you're getting paid 2 days in advance, except, free access to ATMs, et cetera. But the things that are unique about it, one is it has guaranteed credit to it. So anyone that does direct deposit gets guaranteed credit after 2 months of direct deposit, irrespective of your FICO score, what your file looks like. We'll feed the performance of that credit back into the bureau, so we'll help you build credit, and we do this with financial literacy embedded around it. But the other aspect of Pay is because it's using a blockchain ledger and effectively using digital marker, you can't overdraft because it's real time. And so, we say no overdraft fees, but the reality is you can't overdraft the account anyway. It has a Visa debit card associated with it, so you can transact through all the normal rails, but that off on the debit is real time against the blockchain balance. And so if you think about this versus prepaid debit or certainly payday lending, the max rate that we charge on Pay is 30%. And that's for a customer that has absolutely no credit history at all. And we can do it profitably. And so what we're ultimately trying to do is provide a foundation for, especially traditionally disenfranchised communities that haven't had access to financial services or have gotten very poor access to financial services, a solution that levels the playing field for them, with the added benefit that for their communities where the merchants are using Pay as well, you can circumvent interchange expense and be able to transact in a way that benefits your local merchants and local community. We've all walked into the store where we want to buy a Diet Coke or whatever it might be, and it's a $10 minimum because of the dollar surcharge to interchange. PayPal is even more expensive than that now. So, we think that this provides a foundation for a sustainable solution, meaning that it's profitable, right? So you can run it indefinitely. It's not a loss leader. But what it's going to do is drive a huge amount of financial inclusion, which is something that FinTech has woefully undershot since we started talking about this back in 2010, 11, when FinTech really started hitting market. The idea was democratization. We haven't really democratized a lot. And so this through the back of blockchain, I think is going to absolutely level the playing field in ways that we haven't been able to do historically.
Yeah, Mike, beautifully said, and illustrated with clear evidence that we can get there, that we can create that financial services system that really works for anybody. And as we talked about, in the moment, anytime and wherever they are. And I'm going to give Ryan and Adam just a few words here, because I wonder, just as you hear Mike, as you envision investing in a future that looks a lot different than the past, why don't you give us some of your parting words, knowing that, it looks a lot brighter than it did an hour ago to me, that there's a chance for us. So Ryan, do you want to go first, and then we'll close out with Adam? And
Sure.
Yeah.
So I think, as preparation for this, you asked us, what are the 2 things that we need to have the financial services industry work for anyone, anywhere, anytime. And I think they are regulatory clarity on digital assets, which I think we're going to get a lot more of in the relative near future from the president's working group and the Federal Reserve. And then I think it's partnership between traditional financial services and the DeFi ecosystem.
Yeah, Ryan, very tangible and very, very hard to do. But I'm so glad you're on it. And with these guys, it's good. I see a path. Adam, what about you? What are those two things?
So I certainly echo the sentiment that the regulators are going to realize that digital assets are the future, and they're going to try to bring them into the regulated banking system. I think from the consumer standpoint, the part where I get really excited was talking about self-sovereign identity. I think the regulators are going to drop the hammer on Google, Facebook, Apple, in the way that our information is sold. And the ability to control one's information is just going to be extremely powerful to be able to share what we want to share, when we want to share it. And it's also going to speed up financial inclusion and compliance and origination. And so I think that's going to be really powerful, but probably not talked about enough.
Yeah, Adam, thank you. We too think that personal data component is so critically important to unpack, and the larger challenges you just set out. And Mike, I just want to say just thank you. Thank you all for being here, for what you've done and what you will do. Like I said, I think everybody comes away inspired, and we hope you'll return to Boston FinTech Week, and we can have this discussion in more detail.
Yeah, next time we can talk about identity. It's a great topic.
Okay, you're on. So I think the plan now is that I profusely thank you, which I just did. And then you get sent backstage, although you're welcome to stay with me as I say thank you to everyone today. Do you all want to go backstage or just hang out for a minute? What happens?
We'll head back. Thank you.
Ryan.
Okay. Thank you.
Amazing.
Thank you.
Sorry, everyone, we did not get to all the questions. But while Adam might stick with me, oh, there he is. So let me just, on behalf of the FinTech Sandbox team, on our tremendous partner and sponsor, Algorand, for today. There's been an amazing amount of content that's been presented and speakers, and we've been challenged from the morning with Silvio and Steve all the way to just now about what you can do to build a much more inclusive and sustainable finance system. And so I hope you'll join us tomorrow. We're going to kick it off with Abby Johnson, and we have a powerhouse day ahead of us. So if you can, stick around, head over, speak to our startups, head into the sponsor booth, and definitely come back tomorrow. Thanks, everybody. See you soon.